Well, today, the bull's taking another breather after a week of record highs. My next guest isn't surprised by that. He says the post-election rally has been more of a reaction than a real rotation based on fundamentals. He does see broader risk opportunities in the new year. And joining me now is Paul Christopher. He's head of global investment strategy at Wells Fargo Investment Institute. Paul, happy Wednesday. How can you tell that it's just a reaction?
Well, it's pretty typical, John, after elections to see the trades try to go in the direction that winning candidate promised. The problem is, as you just heard from your guests, we don't know exactly when and where and to what magnitude those policies will be enacted. Tariffs, okay, and limiting immigration, okay, but how soon, how much, and how long will it take for those policies to get enacted? And more importantly, maybe, how are the tariffs of tomorrow, I should say, going to be different from the tariffs of 2018 and 2019, which a lot of people are using as a benchmark here. So there's normal sort of post-election kind of reaction. In this case, people thought the deregulation, extending of the Trump tax cuts, that would be good for equity markets. So equity markets rallied. The bond market looked at immigration and potential limits on immigration and tariffs as a source of, well, gee, maybe we should be taking our rates higher on maybe an inflation premium. So there's a term premium that comes in there as the economy looks good and stocks look good. So the bond yields have to rise, and then you add on to that this inflation premium. So you end up with higher yields and stronger stocks. But hey, that's what we've been predicting anyway since August, right? The economy's strong. We thought that the stocks would do better and yields would rise. So how do you really tell the difference? You kind of be patient a little bit here, wait for the pullback, and then stick with the strategy that they got you here, which is really playing for cyclicals.
Okay, but while we're being patient, there's a lot of stuff we don't know. There's probably some stuff, I want to say we know, but we can be pretty sure about. How much volatility do you really expect in yields? Can people lock in, some decent yields with longer dated fixed income here?
Yeah, it's a really good question. So last month we made a shift, and our main focus is to get money out of CDs, treasuries, short-term treasuries, and money markets. Those rates are going down. What we want to do is move money into the longer end of the curve, but there's volatility at the really long end of the curve. As you pointed out earlier, we were at 440 just a couple of days ago, and now we're down at 4.25 again. So ups and downs in those long-term yields will create volatility in your total return if you stick at the long end. So why not build sort of a laddered portfolio? Think of short, intermediate, like 3s to 7s in maturities, and then longer than that. And take out a short, put first in those 3 to 7 year intermediate maturities. And then when you finish building that part of the ladder, then get your long-term allocations up to, let's call it a long-term strategic allocation, where you can maybe take a small bite at the apple every once in a while, dollar cost average into those positions. That way you lock in those long-term yields, but you're not so subject to those whipsaws that you might say if you put all that money in long-term.